Assalamu alaikum. This is the fifth video on accounting for partnership, and we are going to talk about partnership liquidation. We will describe the steps used to distribute available partnership assets in liquidation under the Uniform Partnership Act. We will list the order of priority for each class of creditors in partnership liquidation. We will explain how to prepare a liquidation schedule to settle debts and allocate assets by solving some illustrations. But at the beginning of this session, I would like to thank my son, Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories without which making these videos would not have been possible. I would like to thank Nabiya Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use time for her in making this video. Liquidation means dissolution of partnership where the partnership is terminated. Sometimes it is referred to as winding up the affairs. Winding up refers to closing the operations of a business, selling off assets, paying off creditors, and distributing any remaining assets to the owners. Once the winding up process is complete, the dissolution step comes into play. This is when the partnership firm, formally under the law, ceases to exist. The order of liquidation is: the business should close, compute income to date, distribute income or loss to the partners in their residual profit and loss ratios, non-cash assets are converted to cash, gains and losses are accumulated and then distributed to partners. Gains or losses in liquidation might be from over or undervaluation of assets. Residual ratio is used because these gains and losses are from investing and not operating. Distribute assets to creditors and partners. Let us now talk about how to distribute assets to creditors and partners. The Uniform Partnership Act has a ranking of order of payment of liabilities: those owing to creditors other than partners, those owing to partners other than for capital and profits such as loans, those owing to partners in respect of capital, and those owing to partners in respect of profit. The order of payment ranks the way assets are to be returned to partners, but there are some alternatives. If a partner has a debit capital balance, any loans from the partners can be used to decrease the deficit. This is called the right of offset. If a partner has a deficit balance, that decreases the other partner's access to assets. Payments to partners who might later owe the partnership money are eliminated with the right of offset. It is very difficult to differentiate partners' capital and reinvested profits, so they are usually added together. If partners take non-cash assets, they must first be restated to their fair values. All partners should benefit from the increase or share in the decrease in value of the non-cash assets. The partners who get the asset should get the fair value of that asset. Let us now talk about the steps in marshaling the assets. Partners are jointly liable for all contracts and other obligations of the partnership. Partners are jointly and severally liable for obligations of the partnership business. Joint and several means that legal action may be brought against all the partners together or against any one or more of the partners in separate suits. Personal creditors of an individual partner can seek recovery of the payment from personal assets of the respective partner and under certain conditions from partnership assets. Recognition of the rights of these two groups of creditors and the classification of assets into personal and partnership categories is referred to as marshaling of assets. When assets are sold for less than book value, the partners must absorb the loss. For more than book value, the partners get the gain. When there is enough cash, the creditors should be paid. The right of offset allows loans from the partners to be added to their capital balances. If a partner has a deficit capital balance, he has two options. If the partner is personally bankrupt, the deficit balance must be allocated to the remaining partners in the residual profit and loss ratio. If the partner is personally solvent, the deficit is settled by a cash payment by the partner. After either option, that partner's capital balance is zero. When there is nothing left but cash and capital balances, the remaining cash is distributed to owners. Remember, the cash is distributed based on the partners' capital balances and not their profit sharing ratios. After the last step is done, there are no balances in any accounts and the partnership is liquidated. Let us solve an example. The partnership of X, Y, and Z have decided to liquidate their partnership. At the time the partners share income and losses in the ratio of 2:2:6, no partner can make any payments into the partnership. The partnership sold the non-cash assets for 20,000. Complete the liquidation schedule below. So we have the balances over here, the beginning balances for cash, non-cash assets, liabilities, loan given by one of the partner, and the capital balances of the three partners X, Y, and Z. So first of all, they have sold their non-cash assets for 20,000. So our non-cash assets decrease by 40,000, and this means there is a loss of 20,000 to be shared by the three partners in their profit sharing ratio. So that makes 4,000, 4,000, and 12,000. And the balance now is 25,000. This becomes 0, 15,000, 2,000, 8,000, 3,000, and 3,000. Then they are going to pay the creditors. The creditors are 15,000. And then now the balance is this is 15. $10,000, Next, we are going to offset the loan given by Y. And the totals are 10,000, and now we are going to allocate the deficit of Y among the remaining partners in their residual profit sharing ratio. The residual profit sharing ratio now is 2:6, that is 2 upon 8 into 1000, that gives you 250. So again we make the total, and the total is 10,000, 7,750, and 2,250. Now we are going to make the payment to the partners having a credit balance, and the cash will decrease by 10,000, and this will give us a balance of 0 in the end. So this is the solution of the illustration we have done just now, and I have also added one more illustration for you for practice. In this example, we have the same information except that the non-cash assets are sold for 16,000 and not 20,000. And once you are solve this this schedule, you must have your schedule looking something like this. Remember, the balance in the end must be 0. Let us do one more illustration, and here we have ABCD partnership, and they report the following balance sheet, and these are their assets and liabilities. Now assets in the personal assets and the partnership assets are given over here, and we can see that the personal assets of the partners can be used only to settle the personal liabilities. Only then the balances can be used to pay off the partnership claims. In this case, Alice Amos has more personal liabilities than her personal assets, while the partnership creditors and other partners can recover 83,000 from the personal assets. Now, since Alice Amos has a credit balance in her capital account, her personal creditors can claim from what Alice will receive from the final distribution of partnership assets in settlement of her capital interest. The partnership has a claim of 15,000 and 35,000 from Baker and Carter. However, Baker will have only 3,000 for investment in the partnership to reduce his capital deficit. Carter has sufficient personal assets to pay off her personal liabilities and investment in the partnership to cover her share of partnership losses. So let us prepare the marshaling schedule. We have the cash balance of 50,000, liabilities are 75,000. Amos has a balance of 15,000, credit balance of 15,000, while Baker has 15, debit balance 35,000 and 10,000. Now, first of all, investment will be made by Baker by investing 3,000. So it will be, her account will be credited by 3,000 and investment will be increasing our cash by 3,000, and the total is 53,000. Liabilities still remain 75, 15,000, 12,000, 35,000 and 10,000. Then we are going to allocate the Baker's deficit among the partners. So this is 12,000, the deficit is of 12,000 and this will be allocated among all the partners. 4,000 will be here. Her account is going to be credited by 12,000 and 4,000 for Carter and 4,000 for Davis. So the total is 53,000, 75, 11,000, 39,000 debit balance and 6,000 credit balance. We will pay the creditors. We have 53,000 cash with us. So 22,000, 11,000, 39,000 and 6,000. Now Carol Carter is going to bring 39,000 as she is having a debit balance. So investment will increase cash by 39. We still have a liability of 22,000. So we have a total of 39,000, 22,000 of the liabilities, 11,000, 0, and this becomes 6,000. Now we will be paying the creditors 22,000. So we have a total of 17,000. And now we are going to make the payment to the partners having a credit balance. So 11,000 and 6,000. So we are paying 17,000. So again, you can see in the end, the balance is 0. So the cash is distributed first to liquidate partnership liabilities and then to satisfy partners' capital interest. Finally, let us solve one more illustration. But before doing that, let me tell you, this is the answer for the exercise we have done just now over here. This is the neatly done answer. You can verify when you are solving it. And then let us go into our new illustration, and here we have the balance sheet, and we have all the partners are having a credit balance, and they are sharing profit and loss in this ratio. Carter has given a loan of 10,000 to the partnership firm. Regarding their personal assets, you can see that Amos has a net assets of 20,000, Baker has net assets of 28, while Carter has negative net asset, that is the liabilities or personal liabilities are more than personal assets. And then non-cash assets of 180,000 are sold for 52,000. So the difference of 128,000 is allocated among the partners in their profit sharing ratio. So we have the balances from the illustration: cash, non-cash assets, liabilities, loan, and the capitals. And you can see that the capitals are put in bracket because this represents a credit balance. Now they have sold the assets, non-cash assets, for 52,000, and there is a loss of 128, and this loss is distributed among the partners in their profit sharing ratio. Then we make the total, and the total is 72, and all these numbers are there. Where we have first we are going to pay the creditors for 70,000, and again we make the total, and now we have cash balance of 2,000, and there are no non-cash assets. We have paid off our liabilities, and these are the balances in the partners loan account and in the partners capital balances as well. Next, we are going to offset the loan against the debit balance, and in this case you can see that Carter has given a loan of 10,000, but Carter has a debit balance, so this has to be offset by this debit balance. And once we record it, again you can see that the loan has been written off, and now we have two accounts that are having a debit balance. Now as you can see from the exercise, Carter has a negative 5,000. He cannot bring any more money, so Carter's deficit will be distributed among the remaining partners in their residual profit sharing ratio. And now Amos has a credit balance of 12,500, while Baker has a debit balance of 10,500. So Baker can bring in from her private assets. So our assets cash is going to increase by this investment of 10,000 by Baker, 10,500. So we have a total cash of 12,500, and this is paid to the partner having a credit balance. And now in the end, once we make the total, again the total is 0. So this completes the fifth part on accounting for partnership, where we explained partnership liquidation, and we talked at length about marshaling the assets. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.